Namaskar and welcome to our commodities podcast. I am Ravindra Rao representing Kotak Securities Commodity Research Desk. I hope you all enjoyed the festivities of Diwali. As usual, we'll discuss key developments to watch in the current week. Investors found relief last week as the latest data indicated a gradual slowdown in the US economy, fueling hopes of a Fed pivot. The US CPI data for October revealed a decrease in headline inflation rate to 3.2% from 3.7% in both September and August. Concurrently, the core CPI dipped to an over 2 year low of 4% from 4.1% in the previous month. The shelter index, responsible for over 70% of the total increase, slowed to 6.7% from 7.2% in the prior month, which is a positive sign. Following these soft CPI figures, Fed swaps indicated almost zero odds of another rate hike, with the market pricing in a 50 basis point rate cut by July 2024. During the previous week, US weekly jobless claims rose to the highest in nearly 3 months, and continuing applications for unemployment benefits reached the highest in almost 2 years, indicating challenges for job seekers. Simultaneously, US industrial production and manufacturing output fell more than expected, and export and import prices experienced the most significant decline in 7 months, alleviating inflationary pressures. These data suggests signs of softening labor market and easing economic momentum, aligning with Fed's recent warnings of a slowing economy. The cooling inflationary pressure provides the Fed with flexibility to cut rates in 2024 if needed. Federal Reserve officials welcomed the receding US inflation but emphasized that there's still a way to go before reaching central bank's 2% inflation target. In the commodity space, COMEX Gold prices recorded the first weekly gain in three, while silver rallied more than 6.5% in the previous week. Bleak economic data from the US fueled optimism that Federal Reserve's aggressive tightening campaign has concluded. The dollar index plunged close to 2%, and US 10-year Treasury yields dropped almost 20 basis points in the previous week, enhancing the appeal for the non-yielding yellow metal. Gold prices reached a 2-week high of 1995.3 ounce per troy ounce, and silver hit $24.12 per troy ounce, the highest since early September. Investment activity slightly improved during the week, while holdings at the SPDR Gold ETF rose to 870.45 tons as of November 16th, compared with 868.14 tons on November 10th. Signs of a Fed pivot amid a slowing US economy and easing price pressures might keep gold and silver prices supported. On the technical front, there is a good formation in case of silver. It has formed an inverse head and shoulder pattern, which has the price has penetrated the neckline resistance. However, there is a trend line resistance, falling trend line resistance close to 24 odd dollars, and the high of the break candle is near 24.07. So once it closes above 24.07, we can say that the inverse HNS pattern has been confirmed, and we might see a sharp upside in prices, which might extend towards $27 as well. And in that scenario, the support is near $21.87, which would act as a reversal support below which the pattern might negate. Similarly, in case of MCX silver, the price has to sustain above 73,700, 73,800, and in that scenario, we can conclude that the inverse HNS pattern has been confirmed and the prices might move higher. Coming to energy, WTI crude oil slipped to a 4-month low of $72.16 per barrel before recovering and ending the week near $76 per barrel. However, oil registered its fourth consecutive weekly loss due to signs of healthy supplies and a build-up in US stockpiles, outweighing attempts by OPEC Plus leaders Saudi Arabia and Russia to curb declines. Differing market outlooks by OPEC and IEA also kept investors cautious. OPEC highlighted robust growth trends and healthy fundamentals, while IEA believes bigger than forecasted production growth in the US and Brazil will lead to less tight global oil market this quarter. WTI crude oil might trade a range bound for the week, provided the 200 SMA resistance near 76.50 per barrel holds on a weekly closing basis. On the lower side, $72 would act as a good support. Finally, LME base metals started the week positively due to a weaker dollar and largest cash injection from PBOC in near 7 years. However, metals closed mixed as the latest economic indicators from China dampened the recovery outlook and hurt demand prospects. Chinese industrial output and retail sales growth beat expectations, while property sales, investment in real estate, and home prices slipped in October. On the technical front, there is a good pattern forming in case of MCX copper. On the weekly charts, we are seeing a bullish engulfing pattern, but the pattern to get confirmed, it has to close above 715 on a weekly closing basis. And if that happens, we might see prices going higher towards 735, which is the 60 day moving average, 60-week moving average resistance. And on the lower side, support is pegged near 695, which is also the 200 SMA, and below that we might see further downfall, but it looks unlikely that it will breach that level until and unless there is any major slowdown news from China. So looking ahead to this week, the FOMC meeting minutes and flash PMIs from Western economies will be in focus. The November Fed meeting minutes might acknowledge the impact of tightening credit conditions on the economy. The minutes might signal the end of rate hikes while keeping door open for further hikes if required. However, it's unlikely that minutes will have any major impact. As we conclude this podcast, we express our gratitude for your ongoing support. May your trading endeavors be prosperous and fulfilling. Thank you for tuning in.